Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, welcome to the COB this Tuesday afternoon. What a day. We're certainly in a much better position than we were at the start of the day's trade. Let's have a look at where the CBO 200 is finishing up after, of course, we woke up to those big losses that we'd seen on Wall Street overnight. The Nasdaq in particular down by 4%. This was all concerns about Trump's tariff policies sparking an economic slowdown, Trump himself declining to predict whether the US could face a recession. But as you can see, we started to see a little bit more momentum coming through in the latter part of the day's trade, with the ASX 200 actually halving its earlier losses, mainly thanks to the fact that CBA, the big index leader, recovered somewhat. So we are off by about 60 points, or 0.75% at 7,902 as we head into match off on the ASX 200. Much better than that near 2% drop that we'd seen around lunchtime. So of course that is really the theme of the day, the afternoon ascent that we did see, but a lot of these tech issues as well, and tech is where you have seen a lot of weakness. We do not have the same exposure as, of course, the Magnificent Seven on the Nasdaq, but our tech sector itself, so the likes of Xero, Zip, WiseTech, all under pressure, and the IT sector was the laggard today, down by some 4%. Also had a rebound in consumer sentiment, hitting a 3-year high according to the Westpac Melbourne Institute. Sentiment jumping 4% to 95.9 points in March, but of course that is still below 100, showing that pessimists still outweigh the optimists. Westpac showing though that some of these inflationary pressures are easing alongside the RBA's rate cut last month, meaning that cost of living pressures, they say, are providing somewhat of a clear lift. And the other interesting factor I found from that was the likelihood of buying a household item, so a major item like a fridge or a washing machine picked up, which is always, of course, an encouraging sign on the health of the consumer. Let's have a look at those tech players, though, that really were hit hard today. Xero down more than 5%, Tech One as well off by 5.2%. The banks were where we saw somewhat of a turnaround, CBA only closing down by 1/3%, and ANZ actually up by 1.3% along with Westpac. NAB was pretty flat there. Also looking at what we saw in the energy space, some green shoots coming through there. Strike Energy in particular up 4.4%. There is of course still some downward pressure on the overall global oil prices, though, on fears that these tariffs on Canada, Mexico and China will slow economies around the world. Let's have a look at some of the stocks in focus. The Indonesia focused nickel industries crashing. Indonesia here raising mining royalties, so nickel industries down by 19%. Polynovo also under pressure. Its CEO is leaving in a major update in the bullying saga at the company. Brickworks came through with an update warning about uncertainty around the timing of the US market recovery. Suncorp down by around 1%. It's already received around 8,000 claims due to Cyclone Alfred. Had a great chat about the insurers with David Lane from Ordminet, you can find on our site. Suncorp and IAG are Ordminet's picks in the sector because they still like QBE, but of course it's run up so hard over the past 6 months or so. And Guzman y Gomez also coming under pressure after it released more than 15 million shares from escrow worth more than $515 million. Let's get though to our guest of the day, Martin Crabb from Shaw & Partners. And you came across from your office in the rain. It's been a very gloomy day for markets too.
It has. Yeah, but not as gloomy as we thought it was going to be when we saw the Dow Jones down over 1,000 points and the Nasdaq down at 4% at one stage, and everyone just, replaying Trump's interview from,
Sunday,
Sky Business or whatever it was,
Yeah.
Sky News on Sunday, saying he didn't rule out a recession, said, don't look at the stock market. We're supposed to look at the stock market, Donald. That's what you want us to do. You're measuring yourself by the stock market. So obviously a little bit of an overreaction. But really what we saw, Juliet, today was anything to do with the US got smashed. So if you took the revenue of the company, and we've got it there, so this is from our friends at UBS, just the percentage of your revenues coming from the US. And if you overlay the share price performance today, Telix down 5, Block down 6, Pro Medicus down over 10. Yeah, you could almost overlay the share price performance today versus how much of your earnings are in the US. The flip side is Australia's now defensive. So if you're a global investor and you want to hide from the tariff wars, go to a country that has a trade surplus with the US and really is exporting commodities to countries that kind of need them. So Australia's a safe haven, and then buy stocks in Australia that are domestically focused. So buy the banks, buy the REITs, and all those stocks did well today. So we saw green on anything that was Australian and defensive, and red on anything that was US and growth, but not by a little bit, by a lot. Now the net positives almost outweighed the negatives today, and we almost clawed back. In the top 50, I think we're only down 0.3 or something. So that's where the banks and the supermarkets and the REITs sort of are. So that was the macro view today that very, very strongly came through.
So when you look then at the risk off trade, as you mentioned, with these stocks being hit hard, what do we see in terms of what you've got with total shareholder return? You're looking here at some of the potential entry points that people should be looking at.
Yeah, so one of the many valuation measures we look at is the TSR. So what's that? If we take all the analyst consensus dividend estimates on stocks, we can calculate the 12-month forward yield. Then if we take their target prices and look at what the share prices are trading at today, we can work out what sort of capital gain analysts are expecting. It's not like you get all the analysts in the room and you ask them what they think the market's worth. You just individually add them all together and you get a fair value, if you like, for the market. You then compare it with what the price is trading at, and you can. And this is the chart here, and we've just got this back to 18 on that chart. We go all the way back to 2000 with this. The black line is that fair value. That's made up of what analysts think stocks are worth and dividends. And then the red line or the orange line is what the market's trading at. Now that was as of this morning. The grey line is one we've superimposed, which is the implied 15% total shareholder return, which typically if you can make 15% out of shares, you're doing well.
Yeah, exactly.
Now it's not a perfect buying level, but it's just in the past that's generally been a good nod to investors to say, look, as long as you're happy the black line's not going to collapse, i.e. target prices and dividends are going to hold up, then maybe you should start nibbling at the market. So that's, to us, it's a little bit of a ringing of the bell saying, look, it's now relatively well priced. As long as that black line goes up, you can make some money out of the market.
Let's go back to some of the fundamentals of our market, or what's driving. And very luckily or fortunately, Alfred was downgraded before it really hit the coast. But there is still, as we just heard from Suncorp, thousands of claims, and the Insurance Council said they expect thousands more. Does that put the insurance sector in the spotlight? What are you looking for? Yeah,
we don't really look at that. What we really look at is the pricing cycle. So insurance tends to have these sort of 5 to 10 year pricing cycles where a whole bunch of capital gets wiped out on perils or weather events or whatever, and everyone loses money, and then premiums rise over time so the industry can restore profitability, and then it's too profitable and a whole bunch of capital comes in. So that insurance cycle's been around, since Lloyd's, was created over 100 years ago. We're now at peak cycle, so we've had, most of us have experienced all that premium rate increase on house and contents, motor vehicle, directors and officers insurance, any sort of insurance. So we think rates have peaked. So we've moved out of the insurance sector. I know some people are hanging on. We don't see the cyclones or the bushfires in California, for that matter, as really mattering too much. The insurance companies tend to have reserves for that. They have reinsurance for that. And I think Suncorp mentioned today that the federal government will help kick the can as well. So we don't think you should be buying and selling insurance stocks based on the perils that are there or the perils that are coming. It's more about, we think that the insurance pricing cycle has peaked, and the industry will move into lower profitability, and so we've moved on. We sold all our Suncorp out of our portfolio.
All right, what about the banks? Because as we mentioned, the fact that CBA didn't do as badly as expected earlier today helped the overall market sentiment, but of course there's still a lot of calls out there the banks are too expensive.
Yeah, I mean CBA is way too expensive. If you take that out, the others look a little bit more reasonably priced, and you saw that action today. We saw, I think, ANZ and Westpac are actually slightly ahead, NAB slightly ahead. And CBA's still got to give up ground on the other banks in our view, so we don't own it. But I think there's a increasingly compelling case to say, look, the sector's been repriced down, particularly the NAB, because they had downgrades during reporting season. But if you look at what the RBA is likely to do, they're likely to cut rates, and that's supportive to bank shares. The consumer seems to be holding up quite well. So the consumer sentiment data that was out today was pretty solid. Spending is clearly picking up. Tax cuts are coming through. We're likely to get some government spending heading into the election. So the Aussie consumer looks in reasonably good shape. Still struggling a little bit, but starting to get on top of things. So I think the domestic economy looks really good. And you look at stocks that are exposed to that, obviously the banking sector is one. So, we're pretty heavily underweight the banking sector. It's cost us a lot last year. We've made a bit of money on it this year. That's probably something we'll start looking at. Maybe we need a little bit more price downside, and we'll start looking at the banks. But we would avoid CBA. We'd avoid adding that stock. We'd look probably to add ANZ, NAB or Westpac.
What about the miners?
Love the miners. The miners are actually up today. BHP was up today. So look, I think longer term iron ore is on the nose. It's going to continue to come off. Copper looks really interesting. Lithium's oversupplied. I think you've got to be selective. And even in gold, I think gold's had a pretty good run. That's having a bit of a breather. But we definitely want to look for weakness to add to anything in copper. So anything like Sandfire or Revolution or even BHP and Rio with copper exposure we like. But I think generally speaking, you probably want to take money out of the mining sector. I think where you want to look at is domestic cyclical. So things like Dexus in real estate, Metcash in retailing. Look for some stocks that have got maybe some tailwinds rather than headwinds.
All right, Martin, always a pleasure. Thank you so much.
Thanks,
Martin
Juliet.
Crabb from Shaw and Partners. And the stock of the day today was actually Brickworks, and we were joined on the call by Philip Pepe from Shaw and Partners and Rudy Philippek van Dijk from FN Arena.
Uncertainty is not good for their business. They are exposed to housing. They are exposed to imports. They are exposed to people coming across the border to put the roofs in place to do the labour. So even though they look to halt their production in the lead up to Trump to try and not have excess inventory, the world is imploding around them. So demand has fallen off a cliff. The cost of the other inputs needed to build it's gone through the roof because of the tariffs. You can't get labour, so the cost of actually building has gone up. So their clients are saying, we just can't afford it, and there's a pause.
We all look at the price charts, and we all go like, look, all those dips, all those corrections, all those sell-offs, all those bear markets, they ultimately led to new all-time highs. Yeah? But on an individual basis, there are still companies in this market that haven't recovered from 25 years ago, yeah? From the Nasdaq meltdown. There are companies in this market, almost all the banks, that have not recovered from the GFC. Yeah? And that's not even mentioning the 2020 COVID. So while on a market basis, we can reason it always comes good ultimately, yeah? But that's not necessarily the case on an individual basis. And that's where as an investor you have to be careful in what you hold and for how long.
All right, a down day, but let's have a look at some of the leaders of the session, including New Hope, ResMed. I mean, quite a few people said today that's where you want to be in the defensive healthcare players. It was up 3%. Yancoal also had a good session, as did Cleanaway and Whitehaven Coal. To the laggards, though, and there were plenty of those in today's session, we saw some significant weakness, I should say, in Nickel Industries, I believe. It was down by something like 18%, 18.5%, also weakness in Ramelius, Pro Medicus, HMC Capital and Qantas. But worth noting, Qantas was trading without rights to its dividend, so that is partly behind the big fall that it had. In the small end of town, Aurelia Metals had a good session, up by some 6%. Strike Energy also looking good. And the laggards in the small end of town included these stocks on your screen, including Biomi, which was down by about 11%. All right, tonight there's a little bit out in the US, including January US jobs openings and the NFIB Small Business Index. Tomorrow we've got Japanese Producer Price Index year on year and a couple of stocks ex-dividend, including Breville Group and Brambles. But just recapping where the market is, we're off 0.8% on the CBO 200, 0.9% loss on the ASX 200. Pretty much, I guess, half what we saw around midday. So that is still a pretty good outcome. That was as we started to see the banks claw back some ground, but certainly weakness in the tech players, similar to what we saw on the Nasdaq, which fell 4% overnight. Our tech sector also down by 4% today. Energy, though, utilities, definitely a bright spot. All right, we do it all again tomorrow from 9:45 a.m. Eastern. Please join us then and have a good night.